Welcome to the Tim Booker channel, where wisdom is worth sharing. Wishing you a delightful listening experience. Today, we will be discussing Capital Returns, a book that teaches us how to predict changes in industry profits. Whether you're an investor or planning your career, you may find inspiration in this book. Let's start with a true story. In July 1969, a proposal was passed in the United States Congress during a hearing. Prohibit tobacco advertising on television and radio. As a result, after 1971, there were no more tobacco advertisements on American television and radio. Now, imagine if you were in the tobacco industry in the United States at that time. Do you think this change would be good or bad for the industry? Many people might instinctively think it's a significant setback. How can consumer product companies promote their products without advertising? No advertising surely impacts sales and profits. However, the reality is that this change actually boosted the profits of the American tobacco industry, making it even more prosperous than before. So, what's the logic behind this? It's not that complex. First, prohibiting advertising meant that new brands had no chance to grow, allowing the existing tobacco giants to dominate the market long-term. Second, the tobacco companies no longer had to spend vast sums on marketing, converting those expenses into profits. This made the existing players in the tobacco industry long-term winners. Some argue that this change transformed the tobacco business in America from a good business into a great one. This story has an interesting twist. The proposal to ban tobacco advertising was actually put forward by representatives of major tobacco giants. Now, let's shift our perspective. If you were an investor at the time and saw the government pass a law banning tobacco advertising, what investment decision would you make? If you analyzed it from the demand side, your initial assessment might align with our earlier discussion. It would negatively impact tobacco sales, prompting you to sell tobacco giant stocks. However, if you analyzed it from the supply side, you might realize that it meant no new tobacco brands could emerge in the market. In this case, it would be wise to increase your holdings in tobacco giants. The book, Capital Returns, aims to teach us how to predict changes in industry profits by focusing on the supply side. It argues that analyzing changes in industry supply is a better choice for long-term investors because supply is less uncertain than demand and is easier to predict. For example, as in the case of the American tobacco industry mentioned earlier, the analysis focused on changes in the supply-side competitive landscape. If you observe a significant increase in capital investment and production expansion in an industry, it's natural to predict that there will be increased supply entering the market after some time, affecting prices and profits. In the upcoming discussions, we will delve into more examples in this regard. So, how do you predict changes in industry profits from the supply side? The book introduces a tool called the capital cycle. In our next discussion, we will focus on how this tool works and how to use it effectively. Now, let's learn more about the source of this tool. In London, there is an asset management company called Marathon, primarily focused on equity fund investments. This company is quite unique because it caters exclusively to institutional investors and doesn't even have a sales team. Most clients seek them out. At the time of the book's publication, Marathon managed assets exceeding $50 billion, yet their investment team consisted of fewer than 10 people. While $50 billion may not be considered large in the asset management industry, what's remarkable is that this company consistently delivered top-tier performance for most of the 30-plus years since its inception. Especially during the Asian financial crisis in the 1990s and the internet bubble around 2000, they achieved impressive results against the prevailing trends. Marathon has always adhered to the investment philosophy we mentioned earlier, emphasizing supply-side analysis, with a particular focus on observing the capital cycle. The book we are discussing today contains 60 investment reports written by Marathon Asset Management from 2002 to 2015, providing detailed insights into how they practice this investment philosophy. Although the book was published in 2016, it remains relevant and can still provide valuable insights. Today's discussion is divided into two parts. First, in the initial part, we will explain how a complete capital cycle operates, share some practical evidence related to the capital cycle, and discuss academic research in this area. In the second part, we will explore how to effectively utilize this tool in practice. Okay, let's begin with the first part and delve into what a complete capital cycle looks like. We'll illustrate this with a hypothetical case from the book. The protagonist in this story is an American electronic component manufacturer, and we'll refer to them as Old Ma Industries. Around the turn of the millennium, this company was performing exceptionally well, and those who invested in it were reaping high returns on their investments. At that time, many financial market analysts were closely tracking Old Ma Industries stocks, with the majority giving buy or hold ratings. The company's strategic planning department anticipated strong demand growth for their products over the next decade. Consequently, the CEO announced plans to expand production capacity by 50% over the next 3 years. A prominent investment bank proactively assisted in arranging a stock issuance to fund this expansion, causing Old Ma's stock to soar upon the announcement. At this point, both internal and external analysts were confident about Old Ma Industries' future, expecting rapid growth and substantial profits. However, fast forward 5 years, and the situation had taken a dramatic turn. Old Ma Industries' profits had plummeted significantly, and it was struggling to survive. Its stock price had dropped by nearly half in the past 12 months. Analysts, once bullish, had now shifted their opinions, with most recommending selling. What had gone wrong? Some analysts argued that Old Ma Industries had overextended itself. They had been building many new factories in recent years, often before the previous ones had even recouped their initial investments. Additionally, a new factory they had recently constructed, with a total investment of $2.5 billion, experienced delays and cost overruns. Others pointed out that the decline in Old Ma Industries' profits was due to oversupply in the electronic component market over the past couple of years. Several years ago, the industry had relatively high profit margins, prompting not only Old Ma but many of its competitors to expand production. Moreover, new, low-cost producers had also entered the industry. Consequently, there had been an oversupply in the industry, causing many products to be sold at lower prices and driving down overall profit margins. Some analysts added that Old Ma Industries was facing shrinking market demand. Many countries that had previously been strong consumers of their electronic components had expanded domestic production significantly in recent years. Some had even become net exporters, resulting in a substantial reduction in demand for Old Ma Industries products. Now, let's pause here. The book tells us that the story that unfolded for Old Ma Industries is essentially the first half of a typical capital cycle. In a nutshell, it begins with a promising industry profitability, attracting significant capital inflow. Industry-wide production capacity starts expanding. However, after a while, the return on capital begins to decline, and capital starts flowing out. The author explains that this process has occurred in many industries over the past century or two. From the early 20th century North Atlantic fishery industry to the 1990s global semiconductor industry, the early 2000s European and American information technology industry, the shipbuilding industry in the early 21st century, European and American real estate markets, global bulk commodity industries like iron ore, coal, fresh produce, and aluminum, all have experienced the phenomena we described earlier. The logic behind this rise and fall is not overly complicated, and let's summarize it comprehensively. Firstly, the direct cause of declining industry-wide returns is oversupply. But why does oversupply occur? It's because during good times, people often tend to be overly optimistic about demand. When they see hefty profits and robust demand in the market, existing companies in the industry increase capital expenditure, and many new producers enter the market, aiming for a slice of the pie. Consequently, after a while, product supply in the market significantly increases. We know that product prices are determined by the intersection of supply and demand. If the rate of supply growth far exceeds the rate of demand growth, it naturally pushes down prices, squeezing producers' profit margins. If demand not only fails to grow but also contracts, the situation becomes even worse. This is what happened in the case of Old Ma Industries. Please note that at this point, we are discussing the first half of the capital cycle, a process that goes from rise to fall. The latter half of the capital cycle is a process that goes from fall to rise. If you've understood the logic we discussed earlier, you should naturally deduce how this second phase unfolds. As the industry's profitability deteriorates and the capital return rate hits rock bottom, capital starts to withdraw. Existing players begin to shrink their production capacity, and some exit the market or get acquired, leading to industry consolidation. After a period, there's a noticeable decrease in industry supply, paving the way for a profit recovery, and the industry gradually enters an upswing. This phenomenon has occurred in various industries, such as the U.S. information technology industry after 2000, global bulk commodity industries after 2010, and the European and American beer market. Even the 2008 global financial crisis, which caused significant stock market declines in many countries, provided an opportunity for low-cost investments. The author observes that the best investment opportunities often arise in industries where capital rapidly exits and consolidation occurs after a bubble bursts. This process resembles a natural disaster in a forest, eliminating many withered or weaker trees. The remaining robust trees have more room to grow and access to richer nutrients, resulting in flourishing growth. However, it's essential to note that if external forces intervene in the capital cycle, its speed and direction can change. For example, in the mid-20th century, the North Atlantic blood fishery faced oversupply, leading to a drop in blood fish prices. In this scenario, fishermen found themselves in a prisoner's dilemma. Although reducing blood fish supply was the correct choice from a market perspective, each fisherman had to catch more fish individually to offset the price drop losses. This led to wars over fishing rights and industry turmoil. During this time, the Icelandic government took the first step by declaring foreign fishing vessels couldn't fish near Iceland. Subsequently, Canada, the United States, and other European countries followed suit. The author believes that, from the perspective of the capital cycle, this intervention did not have a positive impact. In normal circumstances, an industry in distress leads to capital withdrawal, some less competitive producers exit, and capacity naturally shrinks, pushing prices upward. However, government intervention resulted in the fish industry remaining in a prolonged state of oversupply and low prices, essentially an extended trough in the capital cycle, which is detrimental to industry health. Nevertheless, some interventions can shorten the trough period. For instance, during the 2008 global financial crisis, the UK and Australia's real estate markets, although experiencing a bubble and subsequent burst, didn't face a significant bubble and quickly recovered due to strict housing regulations preventing rapid supply increases. Now, let's take a brief pause. We've covered the entire process of how the capital cycle operates. It's important to understand that this process is not static but cyclical. Capital flows into high-return businesses, increases capacity over time, and ultimately lowers returns. Conversely, when returns are low, capital exits, capacity decreases, and, with time, profits rebound. The capital cycle's operation is a continuous rotation of this entire process. While this might sound straightforward, applying this tool effectively in practice is a challenge that requires thinking counterintuitively. For instance, consider a scenario where a particular industry is experiencing strong market demand and supply is struggling to meet it. Is this the right time to invest in the industry's leading companies? If you haven't considered the capital cycle, many people might assume it is. However, as you've gathered from our discussion, it may not be the case. Because after a while, the industry could experience oversupply, affecting company profits and future stock prices. On the flip side, if an industry is currently not very prosperous, with minimal capital influx or even capital exiting, but with high market concentration and only a few major players, these companies might turn out to be good investment opportunities. This perspective isn't just something the author derived from practical observations, it's gained scholarly attention since around 2005. Several studies have shown a negative correlation between capital expenditure and investment returns. For example, Nobel laureate Eugene Fama and his colleague Ken French observed that companies with lower investment expansion tend to have higher stock returns, a phenomenon known as the asset growth anomaly. Articles published in top academic journals have also found that companies' stock returns often decrease after asset expansion activities such as mergers, new stock issuances, and new loans. Conversely, actions related to asset reduction, such as stock buybacks and debt repayments, are often followed by higher stock returns. Some research has even suggested that a company's asset growth is a better predictor of future stock returns than traditional investment analysis metrics like market capitalization, price-to-book ratio, or price momentum. So, in the first part, we primarily discussed how a complete capital cycle operates, along with some practical evidence and academic research related to the capital cycle. So, at this point, if you are still inclined to believe in the existence of the capital cycle and wish to apply this tool in the future, let's proceed to the second part. We'll explore how to practically wield this tool. I've distilled the relevant content from the book into 3 pieces of advice. First, Be wary of linear thinking and cultivate cyclical thinking. Linear thinking tends to extrapolate current prosperity or downturn into the future to make investment judgments. The author reminds us that many investment analyses in the market are based on this linear thinking. For instance, in the earlier example of Old Ma Industries, analysts gave buy ratings when the company was thriving and sell ratings when profits were declining, both instances of linear thinking. In contrast, cyclical thinking is different. It requires us to always remind ourselves that the capital cycle is in constant motion. What we see at the moment is just a temporary phase in the cycle. In the future, the cycle's direction may reverse. Of course, if you are a short-term investor and believe you can exit before the cycle reverses, some investment analyses based on linear thinking may still hold value. However, the author suggests that in a world where the capital cycle is prevalent, cyclical thinking is a better choice if you aim to maximize the long-term returns of your investment portfolio. After establishing a cyclical mindset, a more critical question arises: how can we determine when the cycle is likely to reverse? From the previous discussion, we already know that the key to a cycle's reversal lies in changes in capital expenditure leading to changes in supply in the market. Therefore, reversal points often occur when the supply in the market starts to become either excessive or scarce. However, you'll notice that the supply-demand balance often changes suddenly, catching people off guard. For example, when demand outstrips supply, people tend to increase capital expenditures. Still, the change in capital expenditure cannot immediately reflect in actual supply changes. There is a time lag. And when people realize signs of oversupply and want to start adjusting their investments, it's often too late. The supply-demand imbalance quickly exacerbates, and the cycle reversal arrives with it. So, as investors, waiting to act until you see significant changes in supply may be too late. A wiser approach is to act when capital expenditure has already undergone noticeable changes but hasn't yet transmitted to the supply side. However, pinpointing the right timing in this space is not easy. Different industries have varying durations for the change in capital expenditure to translate into actual supply changes. Fortunately, the book provides us with some warning signals of cycle reversals that are not limited to specific industries and can guide our actions. This leads us to our second piece of advice, which is to pay attention to warning signals of cycle reversals. The book primarily focuses on the warning signs of the capital cycle shifting from an upswing phase to a downswing phase characterized by oversupply. Clearly, this is the riskiest phase of the entire capital cycle. For instance, the book mentions that if you observe a series of concentrated IPOs or multiple companies consecutively going public in a hot industry, or if you see several companies consecutively issuing new shares, it's time to be cautious. You can also monitor certain indices that gauge industry concentration, such as the Herfindahl-Hirschman Index, HHI, and the C4 ratio. These indices can provide insights into the competitive landscape of an industry. If an industry's concentration has been consistently decreasing over the past 2 years, it indicates new competitors entering the market, which should also raise concerns. Furthermore, if you narrow your focus to a specific company within an industry, the book introduces an interesting point. When a company begins constructing a grand, costly new headquarters building, this often serves as a negative signal. Similarly, in the book, we can see that Marathon Asset Management is less inclined to invest in a company if it possesses a lavish and flashy headquarters building, as it might signify excessive capital expenditure or frivolous use of funds. Additionally, the book mentions some financial signals. For instance, if a company's financial reports show capital expenditures exceeding depreciation, and the ratio of capital expenditure to depreciation has been consistently increasing in the last 3 years, such as rising from 1 times to 4 or 5 times, this could be a signal that a capital cycle reversal is imminent. Another warning sign is if you find that the cash conversion rate in the financial report, which is the ratio of net profit that can be converted into free cash flow, is significantly lower than the average level of the past few years or is declining year by year. Apart from these signals, the book also discusses various specialized financial indicators, which we won't delve into one by one. Marathon Asset Management's compiled warning signals are not universally applicable, but they can serve as a reference when analyzing an industry. When you're concerned that a hot industry you're following might be on the verge of a cycle reversal and you're unsure where to begin your analysis, these signals can provide you with some guidance. However, merely recognizing warning signals of a cycle reversal isn't enough. It's worth noting that many people do notice these signals but hesitate to exit because they are reluctant to leave a seemingly prosperous industry. Some even knowingly invest in an industry with overinflated stock prices, essentially a bubble, with the hope of making a profit before exiting. The outcome of such actions can often be disastrous. When the cycle suddenly reverses, and the bubble bursts, it may be too late to escape. This brings us to the third piece of advice that can be gleaned from the book: steer clear of bubbles, even if it means exiting prematurely. We all know that after the 2008 financial crisis, Queen Elizabeth II famously asked during a visit to the London School of Economics, "Why did no one see it coming?" The author's perspective is that many economists fail to predict the crisis because they often envisage an equilibrium and rational world in their academic research. In this world, the operation of money and finance is essentially passive, quite distant from the real world. However, if we shift our focus to the market, we would find that many analysts and investors expressed concerns several years before 2008. They observed the rapid growth of credit, incessant financial innovations, the existence of housing bubbles in many places, and raised warnings. Of course, many people didn't believe these warnings at the time and thought that the real estate market would continue to prosper. However, there were also individuals who believed in these warnings and the existence of bubbles. But as mentioned earlier, due to a sense of optimism, they chose to stay in the battlefield as short-term speculators. Even some of those who issued warnings hesitated to exit in a timely manner. The final results, as we all know, were far from desirable. Marathon Asset Management first began expressing concerns about the excessive growth of asset securitization and credit size in early 2002. Over the following years, as they interacted with management teams from various banks, these concerns grew stronger. Fortunately, these concerns led them to adopt a very conservative approach when investing in these banks, maintaining only a small position. However, even with a small position, it still resulted in significant losses later on, though not catastrophic. In the book, we can see their profound reflection on these losses, and one concept becomes increasingly apparent: staying away from bubbles, even if it means exiting prematurely. Alright, that covers the key points I wanted to share from this book. In summary, the capital cycle primarily addresses how to predict changes in an industry's profitability. The book suggests that for long-term investors, it's more beneficial to focus on the supply side of the industry rather than trying to predict changes in demand, as supply-side uncertainties are generally smaller and easier to forecast. How do we predict changes in industry profitability from the supply side? The book introduces a tool called the capital cycle. The underlying logic of the capital cycle is a fundamental principle: capital is attracted to high-return businesses, and once returns fall below the cost of capital, capital exits. The key reminder from this book is that this process is not static but cyclical. Capital flowing into high-return businesses over time increases capacity and ultimately depresses returns. Conversely, when returns are lower, capital exits, capacity decreases, and, over time, profits recover. The operation of the capital cycle is a continuous rotation of this entire process. For over a century, since the early 20th century, we've seen the presence of the capital cycle in many industries. Moreover, since around 2005, academic research has also observed the patterns described in the capital cycle. For those interested in the capital cycle and hoping to apply this tool in the future, the second part of today's interpretation provides 3 pieces of advice. 1. Beware of linear thinking and establish cyclical thinking. 2. Pay attention to warning signals of cycle reversals. 3. Stay away from bubbles, even if it means exiting prematurely. Apart from the content covered today, the book also discusses many real investment cases experienced by Marathon Asset Management, including more in-depth insights into cycle analysis. Furthermore, the book delves into how a company's management team's capital allocation abilities can impact long-term capital returns and instances when the capital cycle malfunctions. If you're interested, I recommend reading the original book for further exploration. Alright, we've reached the end of our discussion on this book today. Congratulations on completing another book. Thank you for your support and attention. Please subscribe to the Tim Booker channel, like, and share with your family and friends. Wisdom is worth spreading, and it opens the door to a brighter future. Thank you, and goodbye.